Tax season rolls around and you're looking at your return thinking, I worked this hard in real estate and I'm still paying this much in taxes. Where are all the tax benefits I heard about? If that sounds familiar, then you need to hear about real estate professional status, because if you qualify, it could mean paying close to zero in taxes. In this video, we're going to cover what real estate professional status is, how to qualify for it, and common mistakes people make when trying to claim it. And as always, consult with a qualified tax professional. This stuff gets pretty nuanced and the IRS loves to audit people that claim this benefit. All right, let's start with the basics. What is real estate professional status, or REPS for short? It's a status given to people who simply work in the real estate industry. The status in and of itself doesn't provide any tax benefits, but if you combine it with material participation in your rental real estate portfolio, it can supercharge your tax deductions. I have seen people who are making bank legally claim close to $0 in taxable income for the year because of this. But here's the catch. Not everyone qualifies. The IRS has laid out some very specific criteria. You can't just scroll Zillow a few times and call yourself a real estate pro. To qualify for REPS, first, you must spend more than 750 hours in real estate related activities during the year and own at least 5% of this real estate business. For example, if you're a self-employed real estate agent, wholesaler, or house flipper, you may pass this test. The IRS has a list of activities that can qualify, which is up on the screen right now. Second, more than 50% of all the time you spend working must be in a real estate related activity. So if you have a non-real estate job that takes up 1,000 hours a year, you'd need to spend at least 1,001 hours in real estate activities to have any shot at qualifying. It's not impossible, but it is a commitment. But wait, there's more. As I said, the status doesn't provide any real benefit by itself. You also need to materially participate in your real estate activities. That means you're not just collecting checks while someone else does all the work. You're involved. You're making management decisions, meeting with the tenants, arranging, or even doing repairs. You're really in the thick of it. There's 7 different ways to meet this requirement, and you just have to meet one of them. I'll go over the 3 that are the most straightforward. The first is that you're doing pretty much all of the work on your rental property, from leasing to managing to maintenance. Another common one is that you're spending more than 100 hours a year on your rentals with no one else spending more time than you on them. And another way to qualify is by spending more than 500 hours per year on your rental activities. If someone else spends more time than you on your rentals under this rule, then you could still qualify for the tax benefits, unlike the 100-hour rule. People in non-real estate industries are unable to qualify for this benefit on their long-term rentals, which means they don't get to lower their taxable incomes from their day job like you may be able to. Now let's cover some common pitfalls. This is where most people get tripped up. Documentation. If you want to claim REPS, you really should keep a contemporaneous time log. This means writing down what you did, when you did it, and how long it took as you do it. Not in March when you're scrambling to put your taxes together or under an audit. Another pitfall, not grouping your rental activities. If you own multiple properties and treat each one separately, it can be tough to hit the hour requirements on each. But if you, or what should really be your CPA, can make an election to group them together, those hours can be added up across all properties in most instances. Also, be careful about what counts towards your hours. As I said, scrolling endlessly through Zillow doesn't count. Reading books or watching YouTube videos on real estate also won't count, even if it's really great YouTube content that you should totally subscribe to. What does count? Things like showing properties, tenant communication, managing renovations, and physically doing work on the property. Basically real operational tasks, not research or dreaming. Now, another really cool part about this status is if your spouse is in a non-real estate related industry and you file your taxes jointly, then if you qualify for the benefits of REPS, the tax benefits could offset your spouse's income as well. So here's the bottom line. Real estate professional status can be a powerful tool, but it's not something you can just casually check off on a form. It takes real work. You have to be active, involved, and borderline obsessive about your record keeping. So in summary, REPS combined with material participation in your rentals can allow you to deduct rental losses against your regular income. You need at least 750 hours per year and more than half your working time to be in real estate activities, as well as own at least 5% of the real estate business. You must materially participate in the management of your rentals to to receive any real tax benefit. You should also keep detailed time logs when you do the work instead of trying to compile these logs at a later date. And finally, not all tasks count, so make sure you're tracking the ones that do. All right, if you found this helpful and want more financial planning for real estate content, go ahead and hit that subscribe button. I'll see you next time.